Yeah, so good morning, everybody. And also good morning to everybody online. I hope they can hear me. Um, so I'll be presenting this work called Economic Incentives for Capacity Reductions on Interconnectors in the Day-Ahead Market. This is a project that it's like a side thing that Dan Hilsoff, this is my colleague with whom I wrote this project. He's actually a good friend of mine, and we were talking over Christmas about energy markets, and we read a news article that we'll show in a minute, and that triggered this research question, and then this project arose out of that. So we didn't actually expect this to become a paper, but it got accepted recently, so that's nice. So it's me and Dan in the picture, and the microphone is very rough. What does that mean? Is it loud or is it? Maybe I can put it further away. Maybe that might help. I'll just put it here, maybe. Stay here. Is this better, maybe? Okay, no big problem. Okay, I'll just try to speak like this. So, yeah, let's just first have a look at the power grid in Europe. So the European grid is very interconnected, as you can see at this picture from NTNU website. And in particular, there are many interconnections between different countries and also between different price zones in the network. And these are crucial for this integrated network to function. If we didn't have these, every country would have to satisfy its own power demand by itself, and that, yeah, basically would lead to a huge loss in welfare. So the existence of these interconnectors is very good for the European system as a whole. However, not always all capacity on these interconnections is available at every time. So if you go to the Nord Pool website, you can find this map, and this shows the available capacity on the interconnectors at a particular date. So here you can see, for instance, that the capacity between SE3 and SE2 in Sweden is, I think this is cumulative over the whole day. It's 175,000 megawatts that way and 136,000 the other way. And these vary per day and per hour. So the TSOs of the transmission system operators of the different countries, they're responsible for, at least in Northern Europe, for defining these maximum capacities, these available transfer capacities. And as I said, they vary per day, and they can be quite a bit lower than the theoretically available capacity. So if you go to this tab in the website of Nord Pool, you can get capacity reduction codes. Now you get this table. I just selected 4 different cables here, 4 different interconnections. And here's one which is operating at full capacity. So there's maximum capacity 7,000 something. And it's operating at full, or at least it has all capacity available all day. This is for today. But there are also different cables that have their capacities reduced. So this one between SE3 and SE4, it has reduced capacity. And the explanation for why it's reduced is given by this code. And you can look up, so sometimes it's even put at 0 for some cable. And these codes, you can look them up in, oh, this is some table. This is another slide from the website. You can look up the reasons why the TSOs decided to limit these capacities, and they can state a whole range of reasons. So many have to do with stability or failures of different parts of the network, and things like that. And there are rules of what type of reasons they can use to limit these capacities. So that's how the system works, or at least should work. These are only the interconnectors. Yeah, okay, but this is what triggered our project. We read this news article. So it says Norway curbs power flows to southern Sweden by 45%. And why did Norway did this? It did this in response to the Swedish TSO limiting capacity to Norway. And things are a bit implicit in this news article. It seems like these TSOs don't want to have their conflicts out in the open. But it seemed like the Norwegian TSO was not happy with some decisions by the Swedish TSO because Sweden was limiting export capacity to Norway. And Norway, the Norwegian TSO seemed to doubt the motivations for this. So there was this conflict between the two. It got resolved after some time. But this triggered a question for us, like, could there be some economic reasons why the Swedish TSO might limit export capacity? So could there be some bad incentives, bad behavior going on? And one other reason why we had this, why this question arose, is that this whole conflict arose in a period where prices were very high. So these are the 10 years of prices in the two zones that this news article is talking about. So the prices were highest in 10 years before. So just looking from the outside, you might suspect, okay, maybe this plays a role, at least to some extent, in this conflict. So electricity is expensive, so maybe there could be some political pressure to keep cheap electricity for yourself or something like that. So at least it's us theorizing about this issue. And then we thought, okay, maybe we can look at this from an economist point of view and see, okay, could these incentives actually exist, and how significant could they be? Yeah, so that's our general research question, like what economic incentives could exist to reduce transmission capacity on interconnectors? It's a very broad question, and I really want to say we do not aim to assess what incentives actually are acted upon in practice. Yeah.
It's a good question. Maybe it's important. Can you just say briefly what's an interconnector?
Interconnector is just a transmission cable between different.
Like, is it necessarily a cable, or maybe it's like if we talk about, are you talking only about electricity?
Mm-hmm.
Oh, okay, about cable.
Power market, electricity market. Yeah, it's just a cable. Yeah. Yeah. So I want to stress that we're not saying this TSO is acting in this way because of this reason. We're not claiming anything like that. We're just looking at this from an economist point of view, like what incentives could there exist? And if they're significant, then maybe that's an issue we should take into account. So we're interested in understanding the mechanism. Yeah, third question? I thought I heard something. Yeah. Okay. So we're interested in understanding the mechanisms and the potential magnitude of the effects. Yeah, so we tried to look at the literature to see if there's literature on incentives like this. And there's a lot of literature first about transmission expansion planning, which is related. Because there they look at, instead of reducing capacity, they look at expanding capacity, which is basically the inverse thing. And then there's a lot of papers that also talk about welfare effects of that, so economic effects of decisions related to capacity. The two main differences with the problem we're interested in, one is that it's expansion rather than reduction, but yeah, it's just a negative, so that's not the main difference, I would say. But the main difference is that these are all long-term decisions. So if we build a new cable, that's a new cable that will exist for a long time. And these TSOs, they can change these capacities every hour. So that's a whole different world that we're living in. So this, in theory, these capacities could be tweaked on the market conditions at that particular hour. So that's something that's not possible in transmission expansion planning. So it's related, but it's not exactly what we're doing. And there are two papers that look exactly at this problem that we identified. There's one from 2005 by Glachon and Pion, and they show that these capacity reductions can help avoid balancing costs. So these system operators, they after they have market clears, then need to do balancing within their price zone because of internal congestion that might exist, and that can be costly, and they're paying for it. So this paper shows that if it can happen that they can put some capacity restrictions on some interconnectors, then as a result, they don't have to pay as much balancing cost in the next day. So I think the mechanism they show is that the congestion can be moved from inside the price zone to at the border. So then they're not paying for the balancing, they're actually earning congestion rate. So that's something they show in this paper. And there's another paper by Horn and Tangeros, and they propose some alternative balancing market design to eliminate this incentive that was identified in the other paper. So both papers focus on these balancing costs and show that these capacity reductions can be used to affect those balancing costs. Yeah, so that's not the perspective we want to take in our paper. We ignore this balancing market. We don't look that far into the future. We just look at the day-ahead market itself. And we ask the question, can there be economic incentives for these capacity reductions through welfare effects in the day-ahead market itself? So one reason why we are interested in this is if you put on your economist glasses again, these TSOs are typically 100% owned by their respective country. So the Norwegian TSO is owned by the Norwegian government. So if you're a bit skeptical, you might think maybe there's some political pressure on these TSOs to act beneficially for Norway. Especially in these days where prices are very high, you could imagine that some pressure like that might exist. So again, we're not claiming that this actually was happening, but it's at least something that we might want to take to put some attention on. So that's the question that we want to explore. Can these capacity reductions affect the welfare in the country that the TSO is in? So that's basically what we do in our paper is, so we don't claim this is what TSOs do or don't. We just say, okay, what if a TSO would like to just maximize domestic welfare? To what extent could it do this? And if the answer is to a very large extent, then that means that these incentives are very strong. So that means that this might be an issue we need to take into account. So this is setting the perspective we take. So in our model, we let the TSO just maximize national welfare and then see how strong these effects will be. So it maximizes consumer surplus plus producer surplus plus the congestion rent that's owned by the TSO. And then we give this TSO the ability to limit export and import capacity on interconnectors. And that's basically what also happens in practice. And we take a zonal day-ahead market based on available transfer capacities. So that's not a flow-based market coupling design. So those are two systems that are in place in Europe. And the reason we take this one is because that's the one that's in use now in Northern Europe, and also the one that relates to the example that we saw on the newspaper. So that's the one we looked into. And there will be one thing for future research to also look at this in the flow-based market coupling setting. Okay, so this is the setting we look at, and then we have two parts to the analysis. One is we look at an analytical framework in which we try to understand these mechanisms. So how can this welfare be affected by these capacity reductions? And the second part is a numerical analysis where we try to see how strong these incentives can be using some realistic data. Yeah.
You mentioned in the report, but what is this national welfare?
It's social welfare, so it's consumer surplus plus producer surplus plus part of the congestion rent that's earned on the interconnectors. It's just economic social welfare. So the first part consists of an analytical framework where we will identify two mechanisms that might lead to welfare benefits. And we started with quite a complicated analytical framework, and now it's become so simple that it almost looks ridiculous. But I think this is the picture. This is the first model, and the second model will be slightly more complicated with a third node. But I think these simple models, they show the mechanisms quite clearly. So let's consider a two-node setting. So we have two nodes, and these nodes just represent two countries, and each country is a price zone with their respective TSO. And we look at the behavior of the second node's TSO. And we make a simplifying assumption. There's only supply in node 2 and only demand in node 1. So this is just to simplify. You could also say, to make it more realistic, there's a lot of supply here, little demand. The opposite here. That could be a more realistic setting. But this makes things easy to think about. So electricity will flow from node 2 to node 1. And then what we can do is we can make basically a supply and demand curve portrayed on this transmission line. So the supply in node 2, there will be export over the line, export to node 1. And the demand in node 1 will be import from node 2. So instead of demand supply, we get import export. So we assume some linear demand here in node 1. And let's assume that at least in this part of the supply curve, we have a horizontal supply curve. So the marginal costs are constant, at least here. And then if this were the situation, and if there were plenty transmission capacity, then the equilibrium would be at F, and both nodes would pay price P bar. And country 2 would get no welfare because it receives the same price as their marginal cost. And country 2 would get this welfare, this green triangle. That's basically consumer surplus in that country. So all the welfare goes to country 1. So you might say, okay, what if country 2 wants to change the situation? It also wants some part of the welfare. Then what it could do is it could limit. So the TSO in this country, they have the capacity to limit, they have the power to limit the export capacity to country 1. If it reduces this, it's basically just monopolist behavior. It could reduce it to X here, and then we get less flow, and there will be a price difference. So now country 2 still gets their marginal cost, but there's still no producer surplus. And country 1 will pay price P1 prime, so their consumer surplus is reduced. But the price difference, so there's a price difference between the two nodes, and that price difference that constitutes the congestion rent. And that is usually, at least in Europe, shared by the two TSOs of the two different countries. But typically half of it goes to one country and half of it goes to the other country. So half of this congestion rent, which is this box, will go to country 2. So now there is a positive welfare in country 2. So basically what's happening, how do they get this welfare? It's because of this price difference that has arisen. There's a price difference, and now there's this congestion rent, and now it also gets part of this congestion. So yeah, so basically stealing welfare from country 1. That's one way to look at it. And the mechanism that we identified is a welfare gain through manipulating price differences. So we create a price difference, and that creates congestion rent, and we earn part of that. So that's mechanism 1, through price differences. Mechanism 2, we need at least 3 nodes to show this mechanism. But we don't need a supply-demand curve, so it's going to be actually easier. So suppose that now node 1 is a supply, pure supply node, and node 2 and 3 are pure demand nodes. So 1 is supplying to both country 2 and 3. If there's plenty interconnection capacity. But now what if country 2 limits capacity to country 3? Then basically it removes some demand from the market. So there's less demand on the market because this country cannot get electricity from country 1 anymore. So what will happen to the price? Well, there's less demand, so the price will go down. Price will go down in this node, so the consumer surplus here will go up. Consumers are happy, and because we assume there are only consumers here, the total welfare in this node will also go up. So one way to think of this is to keep cheap electricity for ourselves. So we're buying, so we're not allowing these other consumers on the market. Yeah, so here the welfare effect is originates from a lower internal price. So the price in our node itself is lower. So that's why we call this the internal price mechanism. So one is based on price differences, and the other is based on the internal price. Yeah, so these are the two mechanisms we identified. And then so that's just from a pure supply-demand economics point of view. Now, from a slightly more practical point of view, we'll do a numerical analysis in which we model the Northern European power system, and we see if these incentives actually pop up. So if we can find situations where these incentives actually arise. Yeah, so we model the day-ahead market in Northern Europe. Yeah, I just mentioned this. So we'll compute these welfare effects. So what we model is this part of, so these countries in the left picture. So we model every price zone as a node in the graph, so that's illustrated on the right-hand side. And the connections, so we take all the interconnections that exist in reality and we model those. And then we focus arbitrarily on Denmark because it's it occupies a central spot in this network, so it's probably modeled most accurately. And then we say, okay, let's say all countries behave nicely, but the Danish TSO is just trying to maximize Danish welfare. So how much could it gain in theory? That's what we are going to analyze. So yeah, one thing we need to make an assumption on is how the market is cleared. And basically, we use a simplified version of the algorithm Euphemia that's actually used in practice. And it's just welfare maximization. So we assume there's a market operator that maximizes total system welfare. And it takes bits from all the market participants, and then it clears the market in such a way that the total welfare is maximized. That's basically what's going on in reality. And there are some constraints, some production capacity constraints, some transmission capacity constraints, and these are the ones that can be affected by the TSOs. And then we have a market clear constraint saying that net supply equals net demand in every node. Okay, then we populate this model with data. We use quite realistic data. We use renewable production data from historical sources, so we have historical production levels. For dispatchable production, like coal plants and stuff like that, we take the installed capacity and we estimate the marginal costs of these of this production based on historical fuel prices, like coal prices, gas prices. Then on the consumer side, we take historical prices and demand levels, and then assuming an elasticity of minus 0.05, which we take from the literature, we take that point and then create a demand curve based on that, on those historical consumption and price levels. And then we take the actual interconnectors that exist between the countries. And then for all the data that's based on historical data, we draw 100 weekly scenarios, so 7 times 24 periods, sampled from 2016 to 2020. That's the data that we use. Yeah, I just mentioned we focus on the Danish TSOs, so they can manipulate the capacities, and then we limit the amount by which they can limit these capacities. So they can either put the capacity at 100% or 50% or 0%. So it's quite an extreme range, but it's only a few options. And that's because we optimize in quite a stupid way. We just try all combinations and pick the best one. Because it's actually hard to define or to solve an optimization model with this as the variable. So we just do it in this way. And then for every hour in all these scenarios, we pick the combination that leads to the highest Danish total welfare. Then we see how much we can gain with it. Okay, then go to some first results. So in this graph, we see it's a histogram of the number of curtailed lines. So Denmark has interconnections to 5 different 5 other price zones, and here we just count how many of them have some degree of capacity reduction. So either fit by 50% or by 100% in all the hours that we tested. And you see that in almost all hours, there's at least some capacity reductions. So that means that almost in every situation, there is at least some potential for increasing welfare by doing these capacity reductions. I think it's 97% of cases where there's at least some potential. And here we see statistics for every different cable connected to Denmark. And we also see that it's not just one cable that we always limit. It's all the cables have, there are situations in which, for every cable, there's a situation in which it's beneficial to limit capacity on that cable. And it's quite evenly spread among these cables. So there's not just one that pops out. Then this is maybe one of the most important results. So, okay, so we saw that there's almost always possibility to gain some welfare by doing this. So how much can we gain? And that's given in this table. So if we take the average welfare changes expressed in millions of euros annually. So if Denmark behaves like this for a year, how much can it gain and how much are other countries hurt by this? So the total welfare gain that can be created is 47 million euros. And to put that in perspective, it's hard to compute this is a change in welfare that can be achieved, right? That's the gain. And we would actually like to compare this to the actual welfare, but it's hard to compute the actual welfare because you need to compute the consumer surplus. So I need the whole demand curve. But because with this value of lost load, which we basically need to model, that's so high that the total welfare will be an enormous number. But you have to compare to a situation without any electricity supply, and it's the cost is just so high that the welfare will be immensely high, so it's hard to compute to that number. So we instead compare this to the value of all electricity traded in Denmark. So all production and demand times the price that is traded at. So just consumption plus supply times the price, and then divide by 2 because otherwise we can't double. And then this is 6% of that value. So 6% of the value of all trade. That's how much welfare can be increased by this behavior. Yeah, so that's the potential welfare gain. And then you see that this gain of 47, it comes at the cost of almost 160 welfare loss for other countries. So the net result is a loss of welfare of around 100 million euros in the whole system. And especially consumers are hurt, especially here in Scandinavia. So nowhere in Sweden, they're especially hurt by this kind of behavior. So yeah, there are strong differences in who is hurt by this type of behavior. Okay, finally we look into, so we identify these two mechanisms. So one question we have is, do we observe these mechanisms in our results? Or is it just one of the two mechanisms that's responsible for everything? We, in fact, do observe both. So here we plot the situation before so if Denmark is not able to reduce any capacity, so all cables are at full capacity. So here's the situation before. You see that the price in Denmark is 35 and it's almost the same as in Scandinavia, which is 36. And if Denmark behaves optimally, then it will cut capacity on this cable, and then it creates a price difference. So now the price in Scandinavia is higher, and the price in Denmark is still almost the same. But this price change will create congestion rent, and Denmark earns part of that. So that's how it can increase its welfare here. So there's a high price difference, so higher congestion rent, and that is responsible for the welfare gain. So that is the first mechanism that we identified for price differences. And we also have an example. This is a bit more strong, I think. So before any capacity reduction, we have a price in Denmark of 31. And then if we limit capacity to Germany, then suddenly we're only paying 18. So we almost had the price by limiting this capacity. So you see the low prices and that leads to higher consumer surplus. And that's in this case responsible for the welfare gain. So that's welfare gain through manipulating the internal price. Then we moved into one final thing. So we allowed capacity reduction up to 0%. But in practice, there's this rule by ACER, by the regulator, that 70% of capacity should be used at all times. So we wonder, okay, what if we enforce this rule? So we don't allow for extreme capacity reductions. How much can we mitigate this behavior by? So this picture, so how many hours do we curtail at least some capacity? Does not change that much. We still most of the hours you can still gain some welfare by reducing capacity. But this picture has changed a bit more. So before we had 47 here, and now it's only 13. So allowing for smaller capacity reductions does mitigate this issue, as you might expect. And also the negative effects on the entire system and on these consumers in Scandinavia is much less. So this rule seems to, if it's imposed, if it's actually followed, then they can mitigate this issue. So conclusion, the question, can there be economic welfare incentives for reducing transmission capacity on interconnectors? And well, in theory, yes. There are these two mechanisms that we identified with these simple models. And we also observed in most of the scenarios that we test, in 97% of hours, there's at least some potential. And some of the welfare effects are quite significant, especially consumers in Scandinavia are really hurt by this. And we actually observed both mechanisms that we identified theoretically. There's one main thing for future work, because also Northern Europe is moving towards flow-based market coupling instead of available transfer capacity market coupling. So we're interested if this whole issue could play a role, and if so, how, in a system with flow-based market coupling. So that's something for future work. And the paper is in applied energy. If you Google my name, you find it. If you're interested, you can read that. That's it. Thanks for your attention.